This is going to be a lot more reliable than waiting for your Dogecoin to moon.
You're now starting to sound like my economics professor.
It is like dating someone exciting but unpredictable.
And how do I get started?
Our report also clearly shows that funds have created rupees 5 crore in wealth. Yes, you heard that right. I'm going to suggest 5 simple but efficient equity mutual fund schemes.
Do I visit some scary bank branch?
Thrilling when it is good but can break your heart when it is bad.
But wait, 12 lakhs in 10 years? Go on, I want to hear.
It is literally easier than ordering food online, dude.
Oh, that sounds interesting. Hi all, welcome to this portfolio discussion. Join with me today is Mr. Duraivel Gunasekaran, who is also the deputy editor with the Hindu BL portfolio. He has a vast experience of nearly 2 decades in personal finance and investing. It's wonderful to have you with us, Professor Portfolio.
Hi, Renal.
Welcome.
How are you doing, dude?
I'm doing good.
Yeah.
How are you?
I'm fine, thank you.
So, today we'll be talking about mutual funds, right?
Yes.
So, I've heard a lot about mutual funds during watching cricket matches. There's always an ad coming up on mutual funds. I've also seen a lot of ads on internet, and even my dad forwards a lot of mutual fund related articles on investing and all. I feel that it's quite boring. It's kind of boomer stuff.
Okay.
I didn't say to offend you or make it sound rude, but that's how our generation looks at it. Well, I don't think we Gen Z folk really need advice from you older generation boomer folk, because we have crypto out there making millions, and also there are many other interesting investment options out there.
Boomer? Haha. Well, let me show you how this boomer can help you to build your wealth smartly before you turn 40. And trust me, this is going to be a lot more reliable than waiting for your Dogecoin to moon.
Seriously, my Instagram influencer friend, he just made 50 lakhs from his Instagram page and from crypto mining. And now he goes about flaunting his Lamborghini out there in Dubai. And this makes me wonder, why should I even invest in mutual funds?
Oh, your influencer friend? Did he also mention in his success story that he lost 30 lakhs last month before? Social media is like those old Bollywood, Kollywood, Tollywood movies. They only show you the happy ending, not the struggle behind that.
I see.
People love posting their wins, but conveniently forget to mention their losses. But anyway, let me ask you something basic. Do you even know what mutual funds actually are?
Mutual funds, investing in mutual funds, I think it's something like many people come together, they pool money in buying something. I mean, but yeah, it sounds so complicated and so boring. I mean, why can't investing be as simple as maybe buying a stock because someone on X said this is gonna, skyrocket?
Good, you got the basic concept right. Think of mutual fund as a WhatsApp group where you and your friends are contributing small sums to buy something expensive together. Remember how you all pooled money to buy that PlayStation for your friend's birthday? Same concept, but instead of gaming, you are building wealth. A mutual fund is exactly like that. You can start with as little as $250 per month through SIP. The fund manager uses this pooled money from thousands of investors like you to buy shares of different companies. When these companies grow and prosper, your investment also grows. This is like owning tiny pieces of Reliance, TCS and Infosys without having to buy the expensive individual shares. You get to be a part owner of these massive companies without needing lakhs of rupees upfront. Here is the thing, you being Gen Z is your superpower in investing, dude. You have got time on your side, which is like having a cheat code in a video game.
Alright.
Starting early helps your money grow through compounding. Basically, earnings returns on your return, which sound boring, but it is magical. Even small sums made consistently can build a large corpus over 10 to 20 years. For example, if you invest just 5,000 monthly for 10 years at 12% annual return, you will have 11.6 lakh, that is close to 12 lakhs. That's like buying a decent car without EMIs.
Oh, that sounds interesting. 5,000 is pretty much what I spend on food every month. But wait, 12 lakhs in 10 years? Go on, I want to hear.
Yeah, that's just a beginning, my friend. If you continue the same SIP for 20 years, you will have around 50 lakhs. Now here is where it gets exciting. If you continue it for just 6 more years, that means making it a total of 26 years. But say,
Alright.
you will have more than 1 crore. So
Okay.
even at 8% annual return, you will have around 30 lakhs in 20 years and 52 lakhs in 26 years. Our report also clearly shows that funds like the Nippon India Growth Fund have created rupees 5 crore in wealth. Yes, you heard that right. Rupees 5 crore through a monthly SIP of rupees 5,000 over 25 years. This is the secret sauce of compounding. Mutual funds can help you achieve several goals. Medium-term goals like upgrading from your current bike to the Royal Enfield you have been eyeing, or buying a car in 3 to 7 years, planning that Europe trip that you keep posting about, or even funding your master's degree abroad. They also work wonderfully for long-term goals spanning 10 to 20 years, such as buying your first house, building a wedding corpus so you do not have to ask your parents for money, or even planning to retire at 40 using the FIRE method. Financial independence, retire early. So you are what? 20 to 23? You have 35 to 40 years before traditional retirement age here. Time is your biggest asset, bigger than any crypto wallet or NFT collection. And because you have so much time, you can take higher risk for potentially higher return. That's where equity mutual funds come in. They are like the sports bike of the investment world.
Okay, boss. Now you have got my attention. Now give me the good stuff. Where should I invest in?
Perfect. I'm going to suggest 5 simple but efficient equity mutual fund schemes. These schemes are passively managed schemes, which I will explain in a moment. Think of this as my top 5 playlist of wealth building. Number 1, Nifty 50 Index Fund. 2, Nifty Next 50 Index Fund. 3, Nifty Mid Cap 150 Index Fund. 4, Nifty Small Cap 250 Index Fund. And 5, Nifty Micro Cap 250 Index Fund.
Wait. No cap. Please explain it to me in a simpler language. I mean, what are these passively managed funds? You're now starting to sound like my economics professor.
Sure. Let me break it down in simple terms.
Okay.
There are 2 types of mutual funds: actively managed and passively managed funds.
Alright.
So think of actively managed funds like having a personal chef who decides what to cook based on what is available in the market. The fund manager is also like that. He actively takes decision on when to buy, sell and hold shares. And eventually the performance depends on how skilled that chef is. On the other hand, passive funds are like having a recipe book that you follow exactly. These funds simply copy popular indices like Nifty 50, investing in the same stock in the same proportion. Both are good options, but I am suggesting passive funds to keep your investment journey simple. Now, let me break down these funds one by one in the order of the risk and potential returns.
Alright.
First up, Nifty 50 Index Fund. This is your entry level fund, perfect for beginners. It tracks the Nifty 50 Index, which includes India's top 50 largest companies by market value. We are talking about giants like Reliance, TCS and HDFC Bank. These funds offer relatively stability since they invest in the well-established, profitable companies with strong track records. Second, Nifty Next 50 Index Fund. This includes the next 50 companies after the Nifty 50, basically the ambitious middle class of the stock market. These companies are typically in their growth phase and may eventually graduate to the Nifty 50. It's like investing in the supporting actors who might become lead actors someday, like R. Madhavan, Sushant Singh Rajput, Shiva Karthikeyan, Vinayagan and Sunil in Tollywood. Third, Nifty Mid Cap 150 Index Fund. Now we are entering in the exciting territory. This fund invests in 150 medium-sized companies that are beyond the top 100 but still have substantial market presence and growth potential. Mid-cap companies are like the ambitious entrepreneurs of the stock market. These funds can deliver superior long-term returns compared to large-cap funds, but you need to have a patience of a saint and stomach of a street food enthusiast. Fourth, Nifty Small Cap 250 Index Fund. Here is where things get spicy.
Alright.
This includes smaller companies with a high growth potential but also significantly higher risk and volatility. These companies are often in emerging sector or early growth stages, which can lead to substantial gain during bull markets but steep losses during downturns. It is like dating someone exciting but unpredictable. Thrilling when it is good but can break your heart when it is bad.
Oh no.
This fund requires a strong stomach for volatility and a long-term investment horizon of at least 7 to 10 years to ride out market cycles. Fifth, Nifty Microcap 250 Index Fund. This is the extreme sports of mutual fund investing. It invests in the smallest publicly traded companies representing the highest risk and highest potential reward category in the Indian equity market.
I see.
These companies are often unknown to retail investors but can deliver exceptional return if they grow successfully. However, many may also fail or remain stagnant. The volatility is extreme. Imagine riding a roller coaster blindfolded while you are juggling. These funds should only constitute a very small portion of your portfolio and are appropriate only for investors who can sleep peacefully even when their investments are doing backflips.
Well, Professor, these returns sound straight fire. But are there any risks involved?
Yeah, that's a good question, dude. These schemes are arranged in a risk return pyramid hierarchy. The Nifty 50 Index Fund is relatively lower risk and steady return, while the Nifty Microcap 250 Index Fund is the highest risk and highest reward option. But note, all these funds are exposed to market risk. I would suggest you to stick with only the first three: Nifty 50, Nifty Next 50 and Nifty Midcap 150 Index Funds initially. You can consider small cap and micro cap funds only you have a stomach of the competitive eater and time horizon of longer than 10 years. Investing in all these funds that I have mentioned would cover about 95% of the listed units of the NSE.
Thank you, Professor Portfolio. This was truly insightful and it slaps way harder than I expected. And how do I get started? Do I visit some scary bank branch with some lot of scary paperwork?
Oh no! These days are long gone, dude. There are several ways you can start your SIP in mutual funds, especially through mobile apps. Because what Gen Z person doesn't live on their phone, right? The simplest way is through your net banking app. Almost all banks offer this service now. You can also use broker apps like HDFC Securities, ICICI Direct, Zerodha, Grow, or apps from the mutual fund companies, or you can find advisors nearby who can make your investment process completely hassle-free. It is literally easier than ordering food online, dude.
Well, thank you so much, Professor Portfolio. It was a pleasure having you here with us. And, I got to learn a lot about mutual fund investing. And after all, it was a really fun take, for us Gen Z and millennials alike. And hey, maybe you're not such a boomer after all.
Welcome to the world of smart investing, young Padawan. Remember, the best time to start investing is right now, while you are still young and have time on your side. Start now, stay disciplined, and always think long term. Thank you.
Well, thank you, Professor Portfolio, and thank you, viewers, for joining. This was a really interesting video and a really fun take on mutual funds. And we wish you all the very best in your investing journey. Start building your wealth, invest wisely, and see you again next time.